Okay, so the first thing I'm going to do is I'm going to share my screen. Let's start with this, share. So do you see the Excel sheet on the right? Do you see the Excel sheet on the screen?
I do. I'm trying to make it bigger, but I can see it.
Okay, let me see if I can make it bigger here on my side. How's this?
Yes, I can see that.
So all you see right now is the first case, case A, right? So what we're looking at here is we're looking at a movie. The movie is $15 million. And in this first case A, we are assuming we're getting a check from one person for $15 million, which is what the movie costs, right? So when we look at that, we're like, okay, one person is one finance source. And the first thing we have to do with every movie, and any time we have a project, we have to figure out what is the actual value of that movie on paper.
Right.
How do we even start our conversation about putting a finance plan together? It always starts with the project valuation, which is a valuation that includes international projections, international sales estimates for all the international territories. What could those be? And it includes the US territory, the US distribution projections. What could that be? In this situation, we are assuming that for the US, we will get 35% of the budget. We're projecting that. So right now it says here, project valuation, step 2, 35% of the budget is what we believe we can make in the US, which is 35% of 15 million. And then we're thinking about what's going to happen internationally. How much money can we make in the international market? Again, it's a projection, it's a guess. And the case study says, we would like you to assume that you can make 75% of the $15 million from the international budget, from the international market. So 75% of $15 million is $11,250,000. That's what we're guessing, projecting we will be receiving internationally from all the territories outside of the US. So if I look at this and I say, I'm thinking I can make 5.25 million from the US, and I'm thinking I can make 11,250,000 from the international rights, I can get a worldwide gross revenue from all the distribution rights that I'm selling of 16,500,000 on a movie that cost me $15 million. That's a projection. It's just a guess right this minute. That's all it is. We haven't done anything. We're basically just starting our business plan by saying movie is going to cost approximately 15 million. We think worst case scenario, we can make 16,500,000 with this movie when we sell all the distribution rights at the worst case take level, right? So here there's no pre-sales because we're not doing any pre-sales. We're getting someone to give us $15 million. We don't need to be doing pre-sales. We also don't need a bank loan because we have someone giving us $15 million. No bank loan needed. Right. We're also not going to do any production incentive because we have someone giving us $15 million. We don't need any of the finance sources. We have someone giving us $15 million and we're going to go make our movie. So the next question then is, what does that look like in the recoupment schedule? When I make my movie for 15 million, I'm actually selling the movie as I projected for 16,500,000, and I have to pay my investor back the $15 million. What would that actually look like? And that's what happens in the recoupment schedule, and that's here. So in this recoupment schedule, and let me make this bigger for you, you see recoupment plan case A, equity financing 100%. We're still looking at, okay, how much money are we making? So the projection that we had earlier now becomes reality. We are actually now selling the US rights for 35% of the budget. And we're actually selling the international distribution rights for 75% of the budget. So we're actually generating with this movie $16,500,000 as we have projected. Right. In the real world, this would normally be more, could even be less if the market has changed and the movie might not be sold everywhere. But for this example, we are assuming we're getting what we thought we would be getting. All right. So far, so good. So then we have to pay some people. So here's what's going to happen. We produce this movie, and for all the revenues that we are receiving from our distributors who we sold to in the US and internationally, we have hired a collection agent to receive all these revenue payments. And that collection agent charges a 1% fee of the money that comes into the collection account. So all that's happening right now, all that's happening is the distributors are buying the movie, they're paying for the movie, the money goes into this one account that is done for this movie by the collection agent, who is basically a neutral escrow agent who collects all the money and makes all the payments to people, right? So they're charging us 1% of the money that hits the collection account. That is 1% of $16,500,000. So therefore, cost us $165,000 to pay the collection agent, right? So then we have a sales agent. The job of the sales agent is to sell all these various rights to the US distributor and to all of the international distributors. It's their job. They take a movie, they take it to all the film festivals and film markets, and they start selling all these distribution licenses so we can make the $16,500,000, because it's not us going out and selling it, it's the sales agent doing it on our behalf. And for this, the sales agent charges us money. They're not doing this for free or because they love us so much. They charge us a fee. That fee is 16%. And that is 16% of the distribution revenues that we are getting. 16% of 16,500,000 is a fee of 2,640,000. They get paid. Next, we have no bank loan. So next in line, we have our equity investor. They want their $15 million back, obviously. They would also like to see a premium. However, there isn't enough money to pay them that premium because our total expenses are $17,805,000. If I sum up all these expenses that we have to pay, the collection agent, the sales agent, and the equity, we get to $17,805,000, which means we have a loss of $1,305,000. And the equity can only get $13,995,000 because that's all we have to pay them. We don't have enough money. So here, all I'm doing is I'm summing up these three numbers. This is my expenses, right? So all I'm summing up, I'm like, okay, now I have this number. And then to get my loss, I'm going to figure out how much money did I make? $16,500,000. How much cost did I have? $17,805,000. And that's how I get to my loss amount. This is the number we're looking for, right?
Okay.
Right, and the equity, I'm basically looking at, okay, how much do I need to pay this guy? 15 million, but I don't really have it all, right? I'm sorry?
It would have been, if there were enough money, it would have been $3 million, wouldn't it?
If there would be enough money, we would have had to pay him $3 million in premium. You're absolutely correct.
Okay.
Yes.
I think I was somewhat getting lost in, like, do I factor that in or not?
That makes sense. That makes total sense, because you were thinking, if I have to pay all these things, I need to list them. And that makes total sense. So it's actually not wrong to say, theoretically, I have to list this because it is an expense. If I add this here, right? Let's do this real quick, just for funsies. Let's see what you would get. Oh, hold on a second. If we would do this, we do this times this. Let's see what we get up with. Our expenses would increase to 20 million. So the loss would be 4 million. And that's actually not the worst idea to think that way. So if that's, how you thought, it's actually not the worst idea. So I would still give you the points in that case, honestly, because you did think about what would all my expenses be. And then I'm going to deal with that. I'm going to have a $4,300,000 loss because I am asked to pay the investor this, and I now cannot. So that does make logical sense. But in the real world, what happens is we can really only pay what we have money for to pay. And that's when I am an equity investor in a movie, I end up getting a portion of my equity, whatever can be covered at a certain time. So I might not get everything. So I wanted to get you into the idea of what's happening actually in the real world. You're not going to have enough money to pay the equity. You're not going to have enough money to pay the premium. And that's what I kind of wanted to ingrain with you, if that makes sense.
And that makes sense. So the equity investor they just get screwed, which is the thing that we don't want.
Correct. In this case, they get screwed because they gave you all the money and your take estimate did not cover all their money from the distribution sales did not cover all their money. And so we now have a loss. So that's that case, right? So we're taking this a step further in the case study B. So let me make that bigger. We see that. So in the case study B, we say same movie, nothing has changed. We get the same worldwide gross revenues because it's the same movie. It's going to make the same money. Nothing has changed. But what we're changing now is the way we are financing this movie. And we're going to say, we're going to do some pre-sales. We're going to do a bank loan. We're going to do some incentives. We're going to do what Jeanette tells us to do. And we want to see how that changes the world of revenues or not. So the first thing we do, as we always do, we are going to do some pre-sales because we want to check the market. We want to see how does the market respond to this movie by just buyers reading the script, seeing how much the budget is, and seeing who the cast is, and basically pre-buying our movie. So we do pre-sale agreements, which are basically just distribution agreements. They're not any different than sales. It's the same agreement. The only difference is these pre-sales happen before the movie is produced. That's why they're called pre-sales instead of sales. So all we're doing is, of our international distribution revenues of 75%, we're now taking some rights away because we're starting to sell off from that bucket of rights. So we're selling 35% of the budget. 35% of 15 million is 5,250,000. And remember that the reason why I'm mentioning this here is I want you to know you're already making money the moment you make those pre-sales, because these distributors make the first payment, their first installment payment of 20% of those pre-sales. So when they sign a deal with us, immediately they send us 20% as the first installment, and then they pay the 80% later when we deliver the movie. So this money is actually sitting there for us to be used in the finance plan. So that's why we want to make a note of it here, available to cover the budget. This is the first money we're raising. So then we go and figure out, what's the bank loan going to look like? How do we get that to be happening? So the bank loan goes by, what are the pre-sales? Here are the contracts. How much money will the bank give me for these contracts? In our situation, the bank says, I'm not going to fund the contracts 100%. I'm only going to give you 80% of these pre-sale contracts. 80% of 5,250,000 is 4,200,000. Does that make sense?
Yes.
Okay. The reason they often do this is because there might be one or the other contract in our pre-sales with the distributor that they might not be all crazy about. They might say, you know what? You have this German distributor that is new. We haven't worked with them. We have no track record from them. We don't know if they pay on time. We're going to reduce that contract a little bit just to be safe. Those things happen when the bank looks at our pre-sale agreements. They make their own risk profile, if you want, to decide how much money they want to give us based on these contracts that we give them. So that's where this 80% number comes into play. So then the bank also recognizes that you already got some money from these pre-sales. You got this down payment already, and they're not giving you another loan for that, because otherwise you would get that money twice. So they say, we're going to deduct the down payment that you already received on these contracts, which is why the pre-sale loan is only going to be 3,150,000 because I'm deducting the 1,050,000 from the loan amount of 4,200,000. That's how I get to 3,150,000. Does that make sense for you?
It does. It does now. I think what I was somehow, I don't even know if I could explain it. I feel like what I was somehow getting lost in was how we got to 3,150,000 essentially from 5,250,000.
Yeah, which is right. You want to understand. Hold on a second. Why am I only getting 3,150,000 if I have pre-sales of 5,250,000 and they're only supposed to be deducting what I already got? The reason is the bank decides I'm only giving you 80%. I'm not giving you the full pre-sales. That's why. So let's look at the next step. On this amount, the bank will charge an interest reserve. It will hold that interest, deduct it from us, from the loan amount. We're not paying them the interest, they're just holding it. And they will be paid later in the recoupment schedule when the distributors are paying and when they make their money back. So right now, what the bank says is we're going to be charging 70% interest on the loan amount of 3,150,000, which is 220,500, and therefore the net loan is only 2,929,500, which is the money we actually get from this pre-sale loan portion. So they're not charging us 7% on the 4,200,000 because we're not getting that. They're only charging us the 70% of the amount that we're actually getting after the down payment was deducted, because they're not giving us a loan for the down payment. So why would they be charging us 70%, right? So we also don't want to pay 70% on the full amount. We only want to pay 70% on the money that we're actually getting. We're actually getting 3.15 million. We're paying on that the interest. Therefore, we have 2,929,500 available from the pre-sale loan. So let's look at the next version of things. I don't know what's happening here. Maybe there is a... Oh, in this case study, I remember now, we're not getting a gap loan. So this part is going to stay empty. So for this case number B, all we get the bank to give us is a pre-sale loan, which is why this entire numbers, they're empty right now. There is 0 for the gap loan portion. Remember that the gap loan portion is the portion that the bank will give us based on the rights we can still sell after we sold the pre-sales. So the bank looks at what is our entire international distribution revenues, which is 11,250,000. How much of that is gone to the pre-sales, which is 5,250,000. How much of that is left after that, which is 7,050,000. That's how they figure out, okay, she can still sell 7,050,000 worth of rights after she did the pre-sales already, because we're basically taking the pre-sales out of the rights bucket. We don't have those anymore. And all we can sell is still the rights that are still in the bucket, because it's a finite bucket of rights. So then they look at that and say, first of all, we have to look at, okay, what's the budget cap? Remember that the bank will never give us more than 20% of the budget, which in our case is $3 million. So here what happens is the 3,525,000 would be theoretically what we would be getting as a gap loan if the cap of 20% of the budget wouldn't be a thing. But the bank says, I don't care how many unsold rights you have, and I don't care what that number is. If that number for the loan amount turns out to be more than 20% of the budget, I will only give you a maximum of 20% of the budget. 20% of the budget would be $3 million because it's 20% of $15 million. So if we would get a bank loan, that would be all we're getting, no matter what. But right now, we're not getting the gap loan from the bank. We're only getting the pre-sale loan. So we put that in here as our second source of revenues. The first source was the down payment from the pre-sales we got. The second source is the loan amount from cash flowing these down payments with the bank, right? So those two we now got. So far, so clear?
Yes,
Okay.
Yeah.
Great. So then in the case study, it says we're going to shoot this movie in a region where we can get a credit or a rebate. 25% of our budget we get from the incentive region where we're shooting. And that's good to know. And then what we do, we go to a lender and say, listen, here's our budget of 15 million. We have an estimate that we came up with that we're going to spend this and this much money in the region. And based on that estimate, it looks like we get to spend 15 million. The net amount that we should be getting back from the region is 25% of the budget, which is 3,750,000. We would like you, the incentive lender, to give us a loan for that in advance of us actually shooting the movie, so that we can use that loan to be a part of the budget. And we don't have to wait until the movie is shot in the region, and then we go to the film authorities to get our money later. So we want to have it in advance. We don't want to wait. So that's what we often do to basically reduce the risk for the equity investor. And that is also what we do to reduce the risk and the work for us to put all the money together for the financing, right? So we get a loan for that. Now, this lender is not just giving us a loan for free. They want to get paid too. So we have to pay them a fee of 5% here. So it's 5% of 3,750,000, which is 187,500. So we're deducting that. So we are left with an incentive loan of 3,562,500. So that's our third finance source here that we will be receiving as a portion to cover the budget. Is that clear?
That makes sense.
Yeah.
I've always had a separate question when I was reading that in the curriculum. Who would we necessarily go to fund that incentive in advance? Because it doesn't explicitly say that.
It says it in a few places, I believe. You're going to find it when you go into the free money module, and you're also going to find it when we talk about finance sources. I think it's week 3. So here's what's happening. You actually have two options. You can go to the same bank that gave you the pre-sale loan and can say to them, listen, I am going to shoot in Atlanta, and looks like my net to the budget rebate after I'm done shooting there would be 25% of the budget. Will you, bank, give me a loan for that as well? And many banks do that. So the same bank that you would go to, that's okay, don't worry about it. The same bank that you would go to get your pre-sale loan, you could go to get the incentive loan. Many banks do that too. Now here's why that's sometimes a little more difficult for you, the producer, because here's what happens. You are responsible then to go to the incentive region later to do all the paperwork with all the expenses that you had in the region, and then get the money from the incentive all paid back to the bank. So it's your responsibility as a producer to make sure that the bank gets their bank loan for this portion. There are specified lenders, this is the second option you have, that do nothing else but tax incentive lending. There's a company called 3 Point Capital. They do this. There's a company called 120DB. They do this. They do only this. All they do is tax credit lending. When you go to the entertainment finance, I think it's Entertainment Partners website, which is also in the module. It's just called entertainmentpartners.com, I think. They have what is called an incentive map. That's a interactive map of the world where you can click on all the different regions and see exactly how much rebates and credits they would give you. And they also have suggestions, or I think they even themselves give you loans for this incentive. So there are various institutions and banks that will do these loans. There are plenty of them. So
that makes
just
sense.
so you know.
You don't, so I wouldn't want it from a bank, and that's where I was like, okay, I'm getting it now.
And the reason why, and I'm glad to make that comment, when you go to one of these specified incentive lenders, they are the ones to then go to the incentive authorities, to the film offices, and say, we want you to pay us. We're going to give you all the paperwork that we are getting from the producer. Obviously, you will have to get that paperwork to the lender, and they then take it to the film office, and they have the whole headache of dealing with the film office to get their money back.
That's the part that was confusing me. Who
Yeah, no,
we
I
got
totally get it.
the loan through. Okay.
Yeah, so just know these two options mean two things for you to do. I personally go to the specified incentive lenders because I don't want the headache of dealing with the film offices. I also don't want the risk of changing legislation while I'm putting the movie together. And I'm sure you've read in the trades that sometimes these incentive regions change their rules and regulations of what is acceptable to them for an expense that they give you money for. They just go and change it. And then we're stuck. I don't want to run that risk. So the minute I do a deal with the incentive lender, many of them, maybe not all, but many of these specified incentive lenders will take on that risk. And it's up to them to then deal with the film offices to make sure they get paid. It's no longer up to me as a producer because I did a deal. I told them, you go to the incentive region authorities, deal with them. I'm out. I'm paying you a hefty fee to take that risk away from me. So please do that. So that's why it's another good reason to go with a specified incentive region instead of a bank. Because with the bank, you would still be subject to that risk. Does that make sense?
It does. It makes perfect sense. Yes.
Right. So now we have $3,562,500 from our incentive lender. We have the pre-sale loan of $2,929,500 from the pre-sale loan. We have the down payment portion of $1,050,000. So altogether, we have $7,542,000 secured in our finance plan. So what do we need from the equity investor? We need $7,458,000 to cover our $50 million budget. So all we're doing is we take the $15 million, we deduct the amounts of what we have secured, and we look at what is still necessary from the equity investor to give to me. So in this situation, without the gap loan, the equity is much higher because we don't have the gap loan that we usually have at 20%, right? So the equity is nearly 50%. So now we want to see if the equity is nearly 50%, are we making money? Is the equity investor making money with this movie? And that's what we're going to find out in this situation. So let's go through it and take a look at it if they do or not. So again, we go to the recoupment plan. We make our $5,250,000 in the US. We're selling our rights again for $11,250,000 internationally. So we get the same $16,500,000 in revenues. The same we had before because it's the same movie, same budget, same rights are being sold. We're not changing any of that. We did get $1,050,000 already from the distribution revenues that we should be getting. So we have to deduct that here because we already got that amount, right? So all we're actually getting in this case that is left for the distributors to pay us is $15,450,000. Is that clear how I got to that number?
Yes. Essentially, the down payment is the MG, correct?
Correct. The down payment is the down payment on the MG. It's the first installment that they paid us on the pre-sales. So we already got 20% of our pre-sales. So we can't get those again because otherwise the distributors would be paying twice for the first installment that they're making, right? Okay, so that's why we have to deduct it. So then people want to get paid. So again, we're paying the same people. We're paying the collection agent 1% of the amount that hits the collection account, which in this case is $15,450,000. That's all that goes into the collection account. And that is all the collection agent gets paid for, which is 1%. And that is $154,500. All right. So then the sales agent wants to get paid. We haven't paid them anything yet. So they get 16% of the entire 1650. So that's the same amount that we paid before. We haven't paid them on the pre-sales. We haven't paid them anything. They're waiting when the money comes in to then get paid. So that hasn't changed either. So it's 16% of 16,500,000 here. See the formula. And that is also 2,640,000. It's the same amount we paid before in case A. Same thing. So now we have the bank loan. Remember that we're now paying the bank loan that is the gross amount that includes the interest, because here is when we pay that interest. So let's go back and look at that. See here, this is the amount that we're paying back because we have to pay the interest now. Even though this is the amount, the 2.92, 2,929,500 is what we got, but the bank wants 3,150,000 because they want their interest payment of 220,500, right? So if we go back here, we have to pay the bank loan back that includes the interest. Does that make sense?
It does, before we actually subtracted the interest, because that wasn't the amount of money that we would actually get to use. But this is what we have to pay back.
Correct, because the bank wants to get paid, plain and simple. So now we go into the equity investment, which was $7,458,000, which is what the equity investor gave us. So we now have to pay that back. We also have to pay the premium on that money. So that is 20% of 7,458,000, which is 1,491,600. So all this is 20% of that. That's all it is, because the premium is now due. So if I put all these together, I sum it all up here, I get 14,895,100 in expenses. So in order for me to figure out how much I have left, I take all my revenues, 15,450,000, deduct all my expenses, 14,894,100, and figure out how much money I have left. And in this case, I have left 555,900. That's what I have right now. So now I have to figure out, do I have to pay people some profit participation? Is there anyone that gets anything? Yes. The equity investor gets 50% of the equity investment in relation to the budget. So remember, they gave us 49.72% of the budget. And therefore, if I take that by 2, so basically just taking that amount, I take the cell, cut it by half, 50% of that is 24.9%. So that's their profit participation, which is 24.9% of the money that we have left. We have 555,900. The equity investor gets 138,197 of that. So we are left with 417,703. So that's what we're left with. We're basically looking at, okay, we have 559,900 in net revenues. We have to pay the equity 138,197. So we're left with 417 and 703. So there's that. So now the question is, what does the equity investor get? Here's what the equity investor gets. They get the premium, which is the first thing we pay them, premium on their money. And the second thing we pay them is the profit participation. So when I put those two together, the equity investor gets 1,629,797 on their investment, which was $7,458,000. So that's basically their, if you want, return on investment amount. Does that make sense?
It does. And it does now, because I guess at first I was also thinking to myself that we're taking the equity principal investment, the 20%, and their profit participation, and essentially adding that into the number that we get at the bottom, which is more than
Of course,
1,629,000.
because you're adding the equity investment, the actual investment. But the question was, what is the premium and profit? What is the money that the investor makes on their money? So when we're talking about what is the investor making on their money, what is their return of investment, we don't include the actual investment anymore, because we set it in relation to the investment that they gave us. So basically, in this case, we get roughly 7.5 million, and the investor on their money makes roughly 1.6 million. So that's the kind of thinking I wanted you to understand, because the equity investor will ask you, if I give you $7.5 million, how much money am I making on that? And the answer would then be, you get nearly $1.7 million on your $7.5 million investment. That's what they want to know.
And that makes sense.
It's not wrong for you to think, if I have to pay the investor, equity investor payment, I have to also pay them, obviously, the investment that they make. You're not totally wrong by saying that, but the question was, what's the premium and profit in that situation? That's what I was trying to get out of you.
This makes sense now. This
Yeah?
makes a whole lot
But
more
don't-
sense. Because
but
when I
don't-
was coming to my numbers and then I was looking at the answers, I was like, I might as well just pick a box because all of my numbers are wrong.
Yes, but you still did the right steps, and that's important. You just had a bit of a logical twist by thinking, I need to make sure that all these numbers go in there because they have to go all in there. So it's not wrong. You don't know. So just, you don't beat yourself up is what I'm trying to say. You tick all the right steps. You just added some money to it because you thought, I also have to include the investor payment and the payment to the investor. It's not wrong, right? So, but I want you to now know what I was looking for is the return of investment money that is conceptually done by adding the premium and the profit up.
Makes sense. Makes perfect sense.
So let's go to the last case. So in funding case C, I'm going to make that bigger for you as well. Same movie, same worldwide revenues, 16.5 million. We're doing the same thing, same pre-sales. We get $1,050,000, haven't changed anything, same loan amount. But what we're doing here is we're going to figure, why is that number different actually? That's interesting. Hold on a second, let me look at something real quick. 6 million. Wow, I think this one here should also be 6 million. Hold on a second. I want to see what that number is. Oh, I see what happened. Yeah, that should actually be, let me just make that change real quick. Doesn't mean anything to our calculations because they don't change, but I want the Excel to be correct. So I'm going to make a little correction right here. So anyway, but it was good that we had this different number because I wanted you to also understand the budget cap. So it's not actually worse that we just did it. So here what's happening is, got the pre-sale loan, same loan, but now we're also getting a gap loan from the bank. So the bank has to figure out how much gap do they want to give us. We have to figure out what is the gap loan going to be. The gap loan, again, is the loan that the bank would give us for the rights that we haven't sold yet and that we will still be selling. So in order to figure out what those rights are to begin with, we're going to look at all the international rights that we have in our rights bucket. We're going to deduct our pre-sale, the entire pre-sale bucket of all the pre-sales that we're making, which is 5,250,000. And we're going to see what is left. And what is left is $6 million worth of rights to sell. So in this case, the budget, the actual gap amount matches the cap for the $50 million, the $20 million cap. It's the same number. So basically, when the bank looks at the take of what is left to sell, they cut that in half because they're banks. They don't want to take risk. They're actually assuming in that moment that yes, you do have $6 million worth of rights to sell. But how do we know? And we don't know that you're actually going to sell all the $6 million. So we, the bank, do not want to take any risk on this because some territories may not sell. Who knows? We're only giving you 50% of what is available to be sold. That is why they cut the 6 million in half and giving us $3 million as a loan. That's their thinking, just so you know. And then we run, of course, the comparison to make sure we're not overstating our cap, because again, the bank will only ever give us up to 20% of the budget, which is $3 million. So in this case, it's both the same. So we're putting that in as our gross bank loan. And then, of course, the bank is going to charge us an interest on that portion as well, which is 7%. So we have to deduct 7% of $3 million, which is 210. And we're going to get a gap loan of 2,790,000. So now we're looking at what do we get for our movie, and it's two gap loans, it's two net loans. The pre-sale net loan of 2,929,500 and the gap net loan after the interest of 2,790,000, and altogether we get a net loan of 5,790,500. So that's all we have right now. Here's what that is. We have to remember what we have to pay back, because we have to pay back the amounts that are also paying the bank their interest, which is the 6,150,000. And how we get there is we're going to add the pre-sale gross loan of 3,150,000. Remember, that's the one we paid back earlier. But now we're also adding the gross loan of the bank for the gap loan, and that is $3 million. So when we go to the recoupment later, this is the amount, 6,150,000, that we actually have to pay back, right? So we should put that somewhere so we don't forget. So the incentive is the same. We're still getting 25% of the budget. We still have the incentive lender give us a loan, hasn't changed. But now the difference is going to be how much money have we raised and how much equity do we still need? So if I add up the 3,562,500 from the incentive, the 5,719,500 from my bank loan, and the 1,050,000 from the down payments, I have now raised $10,332,000, which means I need to get the equity investor to give me $4,668,000 so I can cover my $15 million budget. Is that clear?
Yes.
Perfect. So now we have to figure out if we get a gap loan and a pre-sale loan and our equity is cheaper, are we in fact making more money, A, as the producer, and does the equity investor make money? So what is that going to look like? And here is where we're looking. We're looking at the recoupment schedule. So let's make that bigger as well. So we're starting with, again, we're making 16,500 in revenues. Nothing has changed. We have to deduct the down payment again. So the revenue are the same, 15,450,000. Nothing has changed. We're paying the collection agent same amount as before because we get the same amount in the collection account. We're paying the sales agent same amount as before because they're selling the same amount of rights. We're paying the bank loan more because we get a higher bank loan. Here is where the bank loan comes in, the gross amount of 6,150,000. And then we pay the equity, which is lower because our bank loan was higher. Now the equity gets 4,668,000. We pay 20% in premium on that amount. So altogether, our expenses are now 14,546,100. And we have a little more net revenues now. We have 903,900. The reason for that is the gap loan is actually cheaper than the equity was because the equity is 20%. And I'm paying a higher premium on a higher equity investment that I'm getting than if I would take a bank loan. So the reason why our net loss is actually more than it was in case B is because the equity is more expensive than the bank loan, just so you have a relation. Does that make sense?
Yeah.
So now we have to figure out how much money do people get. Our equity investor gets 15.6% as a profit participation because they gave us 31.12% of our budget, and they get 50% of that when it comes to paying the profits. So that is 15.6% of 903,900,000. So they get 140,67. So we are left with 763,253 in profits for us. So we make more money as a producer because the loan is less expensive to us as a producer than the equity would be. So that's why we also make more money. So the equity payment, again, we are looking at how much premium are we paying, how much profits are we paying, would be 1,074,247 in this case. And they're also getting profit participation. So they get premium and profits, and therefore they get 1,074,247 to them, profit and premium. So the answer here is net revenue is 903,900, equity payment is this. So when we go to case A, B, C in the answers, we basically put all these numbers in our answers. And that's these are the three numbers we were looking for when it came to the answers. So that's why the only mistake you made, and it's not really a mistake because you were trying to be logical and complete, you added the premiums that are due, and you also added the equity investor principal payment. That's why your numbers are higher. Does that make sense? You're still there? Did I lose you? Are you frozen? I hope you're not frozen. Shanyse, oh boy. If I lose you, I'm going to stop the recording and I will log you back in. So I'm going to wait a little bit. Stop sharing right now. Let's see. I think I lost you.